Oh, we learned years ago. One time with Stu Herrera, we did one of those little. I did a little boop boop, just as the cameras came on, and we broke up laughing. We could not stop, and the more we laughed, the harder we laughed. It was really. I mean, tears to the eyes, the whole thing, just hysterical laughing. Finally, they had to take it to a break. Oh,
All right, John and Zoe, we are all set to go.
okay.
Sounds good. Gonna jump right in.
Oh, are we live?
We are.
Yeah, we're live and ready to go. You could start
Okay.
with the intro if you'd like.
Okay. We're very well prepared here. Hi, I'm John Bollinger. I'm the president of Bollinger Capital Management, a company I founded back in 1990. We do investment management primarily for individuals, and we have a strong belief in that technical analysis can help over the long term. So that's what we're going to talk about today.
And I'm Zoe Bollinger. I work with him, obviously, and I also help build a set of portfolios for clients to meet their long-term goals, whether it's something more on the aggressive growth side or something more on the tactical defensive side, which is what we're going to chat with you about today.
Yeah, the defense piece is really important. So many people get shaken out of the markets at the wrong time because of some major decline or some untoward events in the world economy or something like that that cause disruption in the stock market. And then they have trouble getting back in. So we're going to deal with those ideas today via a tactical overlay to portfolio management that allows us to earn realistic returns at the same time that we're reducing volatility. So the classic is buy and hold. It's the Academy has been talking about buy and hold for the past 70 some odd years, basically the entire post-World War II era. And the idea is index and forget it. Typically, the S&P 500 is the index of choice, although many other indexes can be used. The idea is that you can earn about 8.2% by holding the S&P over the long haul. That works out to be about 4.39 real return. That is an inflation adjusted return. And then starting in the 60s or so, we got index funds so that we could invest directly in indexes. And typically they offered very low fees, and it was a sort of no fuss approach. People would simply buy one of these index funds and perhaps in a retirement account. One very popular approach to this in the 1950s and 1960s was dollar cost averaging. That is putting a little bit of money into the index fund each week or month or quarter, whatever suited you. And so you would continue to accumulate the index over time, despite its ups and downs. So those are the basic ideas that we're going to talk about. And the problem is that there are massive drawdowns, and very, very few human beings can take the heat. In 2000, we saw a drawdown of 49%. That is, your investment got cut in half. And over a period of 31 months. So, coming up on 3 years. And that stopped an enormous number of people from investing, many of whom just never came back, despite the fantastic returns that were offered in the next couple of decades. In 2007, it was a minus 56% decline, and it lasted over 17 months. 2020 was the COVID decline. It was super rapid, 1 month, 34%. And then the most recently, 2022, we had a decline of 25%, and that took 10 months. So the point here is that these declines cause so much pain, they stop investors from investing. They just the phones at the brokerage houses and ring, and they say sell, sell, sell. And the problem is that people never get back in. So they've enjoyed the pain, but they're not getting to enjoy the gain. So after these events, there are often very long recovery times as well. In 2000, it took the market 7.2 years to make a new high. In 2007, it was 5.5 years. 2020 was pretty lightning round, just 9 months before we went to a new high. And most recently, the decline in 2022 that lasted almost into the end of 2022 was a 2.1 year recovery time. So there's another issue here. If you can't stand the declines, and they don't, and for some reason you're able to live through them, the stock market has another way of getting you out. And that is these very, very long periods where stock prices don't go anywhere. Most famously, 1934 to 1950 or so was a 16-year run where the stock market went nowhere. And then again, 1966 to 1982, another 16-year run, and then another 16-year run from 1998 to 2014. So if the stock market doesn't shake you out with fear, it'll bore you to death. So anyway, we have some alternatives to that process that we'd like to talk to you about today.
So there's some classic alternatives that I'll go through relatively quickly that you're all familiar with, and they all have pros and cons, So the obvious one is the 60-40. You take some, might be depending on your age and your risk tolerance, it might be a 70-30, it might be an 80-20, but the idea that you pick a risk asset, the index of your choice, and you assign that one weight, and then you add a defensive asset for a set percentage of the rest of your portfolio. And that does work. If the goal is to lower your volatility somewhat, you can see on the chart here, this kind of runs through from prior to the great financial crisis through to today. And the red line is what a 60-40 performance is. And it cut off a nice chunk of the bottom here in 2009. And it runs ahead and outperforms the S&P for a little while until inevitably the index catches it. And you kind of see a similar piece. 2022 was an interesting example and really a problem time for this, because we really these portfolios operate on the idea that bonds are going to move counter to stocks, which is true in many declines, but not universally true in declines. And we saw that pretty acutely and painfully in 22, where usually what would happen, or the ideal of what would happen, is that bond piece would provide you that stability during the downturn. And then you'd get some upside from the equity in the interim. And 2022 was one of those unfortunate times where both of them went down together, which was not ideal. And so, the pros and cons of this are pretty widely known. I'm not going to go through every entry on this table, but it gives you a sense. The 60-40 does cut down on that downside. Sometimes really meaningfully. You got about half as much drawdown during the dot-com crash in 2000. Sometimes less meaningfully in 2022, where it cut off about 4% of the drawdown, but you still had a quite painful 20. So to some degree, it does ameliorate always that downside for you, but maybe with greater or lesser success, depending on your asset mix and depending on the time. But you give up quite a bit in return for that drawdown, because you are carrying basically a weighty asset in your portfolio over time. And we don't have a graphic for it here, but the real power of investing over time is compounding returns. So those little incremental returns that you get every year when you look at them over years and years and years, that extra 0.5%, that extra percent that you got that year, it really grows and builds and kind of snowballs up to the good results that we all hope for from investing. So the 60/40, over time, annualized, compounded, you pay a lot for that drawdown protection. And, you want some drawdown protection because as John went through, sitting through that 50% drawdown is not the answer.
Yeah, you can sort of think of it this way. The 60/40 portfolio does offer some drawdown protection. It's at a cost, and that cost is roughly a third of the yield of the S&P 500.
Yep. So, can we do better? I think that we can. And there's a bunch of different ways to do better. We're going to talk you through one today. Both, this is something that we have built and offer, but it's also a conceptual framework that if you want to build your own, you can kind of use this to think about the way to structure something like this in a way that's suitable to what you're looking for. I know the theme of today's money show in general is value, and this maybe isn't a traditional definition of value, but it's a way to create value. If you can capture a little bit more of that upside and a little bit less of that downside, it really makes a difference over time.
So the idea here is that market timing is not a bad word, but the approach to it has to be rigorous. What we're trying to do is avoid emotion in both exits and entries. It's a very important concept because the efficient market hypothesis, which the Academy has endorsed for decades, suggests that market timing can't be done. But the fact is that market timing can be done. It just has to be done in a very unemotional and very rigorous way. There's lots of data out there to support market timing, and it can be used, as we will show you, to create portfolios that offer superior risk and reward characteristics. So the goal is to reduce volatility. We want 60/40 like drawdown or protection, but we don't want to give up the 1/3 of the S&P's yield that you give up to participate in the 60/40 approach. So we want to give up the absolute minimum amount of upside performance that we have to. So no single indicator is always right, and that's really important. So we are going to, in building this portfolio, we're going to diversify in three sets of assets. We're going to diversify using the S&P 500. We're going to diversify using the NASDAQ 100, and we're going to diversify using a list of alternative securities. And each of those has a separate market timing mechanism attached to it. So we have the diversification across asset classes and diversification across methodologies. It's very important that you diversify on both axes. So when we're creating a tactical system, I'll walk you through sort of the specifics of one example that we run. John just touched on the overarching idea, but that piece that you want to use not only different assets, but different methodologies, I think is something that we've found to be very, very critical. There is no single indicator that catches every possible signal all the time. If anyone has found one, please give us a call. Oh. But generally speaking, there is tried and true methodologies that work year in, year out, and they will miss that one time. And it doesn't even mean that they're broken. They're just individual cycles and occurrences that happen. The market will always keep you on your toes. So what you want is a system that doesn't hinge on a single point of failure. You want something that has a few moving parts that allow you to, if 2 out of 3 are right, you still have a really good outcome. And that's what we tried to build here. Yeah, that's exactly right. The diversification, we go all the way back to the 1950s. People realized how important diversification is. We've just taken it to the next logical level.
And so this portfolio that I'm using as an example today is run in thirds. It has a first tranche that is just a holding in SPY, and you're either in or out based on the signal. And as we've talked about, this we use different signals for each of these tranches that are based on different pieces of underlying data. So hopefully, and so far this has proved to be the case, if they're not replicating each other, they're not based on the same data, so everything's not moving in lockstep. You'll see different pieces of this respond in different ways, and that's what makes it successful. So this tranche is based on a set of indicator data that's entirely based on the price movement of the underlying asset. So as we see price fluctuate, we'll see SPY move in or out. And we're fortunate to, for better or worse, we had some inflation, but the upside is that we're now in an environment where cash yields again. So getting out of an asset, you're still getting some yield if you have some time where you're in a defensive mode, and you're also cutting off that drawdown. The second piece uses QQQ. So we like to look at something like this in terms of assets that provide some not only diversification, but some different characteristics that we're looking for. So QQQ has those bigger swings. It has that greater upside momentum that will help boost performance, but it also has that greater volatility to the downside. So you do want to balance that with something more tactical like what we're talking about. If you're building something like this for yourself and you're looking at something maybe more conservative, more stable, maybe instead of a QQQ, you look at a gold as your other asset, or maybe rather than SPY and QQQ, you think about something like a growth and a value fund, working on different indicators. You can play with this in lots of different ways to get at something that will meet your particular goals, but the fundamental piece is that you want a diversity of assets and a diversity of signals. And in this case, we're also looking at that kind of in QQQ or in cash and based on an indicator signal. For this one, we use a set of breadth-based indicators to make our decision point.
I should back up here for a moment. The SPY and QQQ are both ETFs, exchange traded funds that trade on the stock exchanges like a stock would. Very liquid, very easy to get in and out. They're what are known as index funds. SPY follows the S&P 500 index, and QQQ follows the NASDAQ 100 index. So these these index funds that are available now and super liquid, easy to get in and out, really make this sort of market timing very easy to do. In the old days, if you would have to sell this giant basket of stocks, and it would be really, really hard to do. But today, these funds roll up that exposure for you and offer it to you for just a few basis points. It's really quite remarkable.
And the third piece of this is a little bit different. Rather than an in or out approach, this is always in, but we're looking at a rotation amongst assets. For this third, we have a list of alt ETFs. So this could be something like where you might see those bond options represented. So you might see a traditional bond index, something like floating rate or TIPS. You also have the option for some international exposure, depending what markets you follow. You may have heard developed markets outside of the US have been real outperformers for the first half of this year. So something like that would be in here. A selection of commodities, maybe gold, maybe some generalized commodity funds. And you can structure a list like this kind of as you wish to provide those exposures. But what we're looking for are things that aren't deeply correlated with the other assets that you're already using. So since we're using SPY and QQQ for the other 2/3, we want things that move a little bit independently or perhaps a little bit counter-cyclically to those other assets. If you were using a value index and gold for your other two assets, this might be where your growth in technology lives. It's just all getting back to that idea of both a diversification of signals and a diversification of assets.
Yeah, the way we approach this is pretty interesting, actually. we developed a list of ETFs, obviously starting with SPY and QQQ, but then trying to find ETFs that had the least correlation to the stock market in the US as is possible. And we just build up a big matrix of all of these and look at the cross correlations between them. So the ones with the lowest cross correlations are the ones that we end up using in this list. And you know, those correlations obviously change over time. They're very dynamic. In fact, people believe that they're somehow static, but just like volatility, they're quite dynamic. So we review this list on a regular basis, make sure that we have you know, assets here that will provide proper diversification to our existing positions, either in cash or in SPY and QQQ.
Yep. And so for this one, rather than having that in or out, we do a relative strength-based rotation. So what that means is that we look at our universe of ETFs, and at the beginning of the month, we pick the 3 that have been performing the best according to our calculations. So we look for things that are growing strongly, but with some smooth trajectory as well. So you don't want to buy the thing that is hockey stick, exponential growth up and about to crash. We're looking for something that's been providing steady outperformance in over recent time. And we'll hold those 3. And then at the end of the month, we'll reevaluate the list. And if one of those has fallen down the rankings and another ETF is providing that outperformance in the current environment, we'll rotate into that. So this one actually won't go to cash necessarily in a downturn, although it has some assets in it, or the list that we're using this time has, you know, something like a T-bill like asset that can, so when that's providing outperformance compared to its peers, we'll rotate into cash like assets here as well.
Yeah, Zoe before mentioned that one of the assets in this rotation are TIPS. Those are Treasury inflation protected securities. So, you know, almost by definition, that's going to have very poor correlation to many of the other assets and provide a safe haven in times of troubles.
So what does something like this look like? You know, why do something like this? And I'll let John talk you through some of the testing that we did.
All right, so we just took a nice long bite of time here. We started in January 1st of 2007. We happened to, this test was completed in July of this year. And we broke the portfolio into 3 tranches. The first tranche is SPY with a market timing mechanism based on price. Second tranche is QQQ with a market timing mechanism based on market breadth. The third is a selection, a relative strength selection of 3 ETFs from a larger list and based entirely on relative strength. So we have 3 different sets of assets and we have 3 different methodologies. So here are the results. You can see that the purple line is the benchmark for the 60/40. Why is 60/40 our benchmark? Because this was an effort to beat 60/40 to talk to investors who liked a 60/40 type of approach and say that we can do better than 60/40. So the gray mountain is the actual performance of this actual. It's the tested performance of this approach over this time period. And you can see just visually on the chart that we managed to ameliorate the drawdowns and B, outperform the 60/40 and outperform SPY on its own. So I know they say that you can't beat the market, but this is pretty good example of how and why you can beat the market. So some returns here. SPY buy and hold over this period returned 10.49% with a maximum drawdown of 55, almost 56%. 60/40 as you would expect, about a third less than SPY, came in at 7.1, and about a third less drawdown than SPY at 35. Our BCM tactical approach came in at 11.77%, so we actually beat SPY while we were at it, and we have the least drawdown of any of the three at 23.75%. Now, I should say that as system designers, we worked on this very hard. You know, we can actually build systems that have even less drawdown than this. But again, the performance penalty, you have to pay Peter. You can't you're robbing Peter to pay Paul. We can work on getting that max drawdown even lower, but it's going to be at the cost of the annualized rate of return.
So the moral of the story, kind of what we're looking at, is just reframing the narrative a little bit. There's merit in something like buy and hold, and there's merit in something like a 60/40. For a lot of investors, the goal is that no muss, no fuss, set it and forget it. Maybe you have, auto deposits monthly or quarterly from your paycheck or into your 401k, or just saving that you do, and it goes in. And if you can really not look at it, you get that market return over time. However, you get those big drawdowns, or you can do asset diversification with the 60/40, or plenty of equivalent. There's permanent portfolios that look at cash, equities, gold, all sorts of different asset mixes. But you have the drag of those assets when they're underperforming. And the narrative for a long time has been you can't beat the market. You can't beat that. And to some degree, that's true. None of these systems are going to 100% outperform every year in every environment. But over time, especially compounding over time, there's really value to be added in taking a more tactical approach. And with what we walked through today, it's something, it's buildable, it's doable.
So I think it's really important to understand that this sort of approach has a very long lineage. In the post-World War II era, many people worked on what were called formula plans. There were systematic approaches to investing. Lucille Tomlinson famously wrote a book on the subject. So there's a very long lineage, and this is really the beginning of quantitative analysis as we know it today. And so we're carrying on, we're standing on the shoulders of giants here, but we have modern technology, we have modern tools and techniques, and so we're able to do actually better than they were able to do.
So, these are volatile times. No one sat through the first half of this year and thinks you always take a smooth path to where you're going. And taking something more tactical like this can smooth that path, which can keep you in the markets, can keep you investing rather than getting shaken out and just preferring to sit on the sidelines.
Yeah, it's really important. It's so many people get shaken out during these big declines, but that's not the real problem. The real problem is that they often have a tremendous trouble getting back in and earning the subsequent returns that are really the best returns the market has to offer in these periods after these big disruptions. So this type of approach can make the trip through market volatility much more palatable and allow you to earn market-like returns.
And so if you're thinking about things like this, if you're looking at building this, or you're curious about how stuff like this is structured, the real takeaways are no one has the magic indicator. Don't build everything depending on one specific indicator or all indicators that are based on one specific data size. So don't do all volume, all breadth, all price. They each bring something different to the party, and when one maybe isn't as represented in a specific drawdown, you want to be able to lean on the others as well.
There's also the idea that you can let us do it for you. Want to be strategic. That's a problem for a lot of people because we actually follow the markets on a daily basis. So when we get these signals, we can act in an appropriate manner, and that's something you don't have to do.
So I think we'll leave it there for today. We may have left like 1 minute for questions. So if we've got any, we're happy to take them.
Yeah, excellent presentation. We did have some questions, Roland. The first question was, did you invent Bollinger Bands?
Yep.
I did. I did. I invented them long ago, and in the process of developing trading systems. We were using fixed width bands at the time, and they were problematic, and I needed something that was more fully adaptive. So, yep, I did that.
All right, perfect. Another question was, do you ever use the VWAP?
We do, not in this context. So VWAP is volume weighted average price. It's a way of calculating the average price that a stock traded on a given day. It's frankly beyond our talk today, but VWAP can very important and very useful tool.
Okay, and another question was, are all your criteria for all three systems proprietary?
Yes.
Yeah, in this particular case. There's some stuff, obviously the formula for Bollinger Bands is broadly publicly available. And we do make a chunk of what we do publicly available, but for this particular system,
But the truth is, I think you could figure it out. We've
Yeah, you
given you
probably
enough today to figure it out. The first tranche is basically momentum of some form. It's price driven. The second is breadth driven. So examine your breadth indicators, and the third is a relative strength approach. So you ought to be able to puzzle it out for yourself if you wanted to.
and honestly, to some degree, like the difference, price, breadth, and relative strength, like all three have different calculations and different formulations that you can use that might be more or less suitable to an individual or their goals. So there's not a perfect answer, even in terms of the exact criteria.
And it's also interesting that many of these indicators are very highly correlated. So we might use X and you might use Y and might end up with very similar results.
Probably true.
All right, thank you for that. Another question was, you mentioned that you do offer services. Where can our viewers go to find out more about those services and maybe the advisory fees?
So for our services, the last entry here, BollingerCapital.com is the place to go. There's contact information there. Give us a call and we'll be happy to chat with you about our services and our fees.
Yeah.
All right.
And you can also, for some of them, like more specific stuff, you can just shoot me an email also, and I'll be able to give you a more precise answer depending.
All right,
Yeah.
perfect.
In fact, we'll field questions about any of this. No problem.
happily.
Happy to do so.
Perfect. Thank you very much. I think we're out of time now. Like I said, that was a very, very good presentation. I enjoyed watching it, and we appreciate all the attendees that asked all these great questions.
No, thank you so much.
Thank you. We
Thank
appreciate
you.
it.
Take care.